Hi, welcome to the Main Street Macro. I'm Neela Richardson, and this is my best friend Lavender. But when it comes to the economy, the best friend for the economy is a really good central bank, at least when there's high inflation. And this week and this month has been very important for two leading global central banks. First, the one in Europe, the ECB, and also the one here right at home, the US Fed. The ECB met last week and raised rates by a quarter of a percentage point, an attempt to tame inflation. It's been an ongoing struggle on both sides of the pond. And next week, the Fed here will meet in Washington, D.C. to figure out whether they're also going to raise rates or keep them steady in order to hopefully keep that inflation direction moving in the right path. So, given that there's a strong relationship between central bankers and the US economy or the European economy, I'd like to kind of walk you through how the ECB and the Federal Reserve are similar yet different. Well, the first place of similarity and difference is that they both have a 2% inflation target. And they're both trying to reach those targets and have been since the pandemic. But there's a slight nuance in the difference between how they go about it. You see, the Federal Reserve has a dual mandate. That means that they have to be watchful of price stability, making sure that prices stay moderate and again at that 2% target, but they're also really focused on the labor market and they have a mandate to ensure full employment. Now, what is full employment? Well, it's really just a theoretical concept. So in some sense, it's whatever the Fed wants it to be, but they want to make sure that unemployment doesn't get too high. The ECB, they don't have that second mandate. They're only focused on inflation. So they can be very, very focused in whether or not they're hitting that 2% target. Now, the second point of similarity and difference is that they both have had really sticky inflation struggles over the past year. Now, inflation started out very different in the two economies. US style inflation was really driven initially by high demand and supply chain woes, whereas European inflation started out with their dependence on Russian oil and the effects of the war in Ukraine. Since that time, though, both sides of the pond are feeling the effects of wage inflation and services and the service inflation, all those things that consumers actually receive in terms of services and not actual products has made inflation really hard to control and bring down. So for the US, if you strip out those volatile oil and food prices, we have still core inflation around 4%, a little bit above that. Whereas in the ECB, it's around 5%. And again, it's not about goods, it's about services. So still trying to keep that coming down and not up. Now, the third part of difference and similarity is the economic outlook. Good news. Both regions are expecting growth this year, despite some projections by some economists of a hard landing or a recession. But their paths are very different. In the US, the outlook has actually increased for the third quarter. In fact, if you look at major surveys of forecasters, we're seeing growth around 2%. For Europe, they're actually degrading their outlook. The latest news from last week at the ECB press conference is that they're expecting those 20 countries that make up the Eurozone to grow by less than 1% this year. So slower growth expected out of Europe. Now, what this all means is that inflation is still a struggle, even though it's come down in both regions a lot over the past year. And what consumers are going to have to get used to, whether they live in the US or whether they live in Europe, is higher interest rates and higher borrowing costs for a little bit longer. Well, thanks for watching the Main Street Macro. Thanks for joining me and my friend Lavender here. For more information on the week ahead, all of those central bank decisions coming out of Europe and around the world, please check out adpri.org.